September 2008. A bank collapses overnight. 158 years of history gone instantly. $600 billion vanished into thin air completely. Retirement accounts disappeared. Millions lost their jobs suddenly. But the real cause started with something incredibly simple. A lie so basic it fit on a billboard. Why rent when you can own your home? It's 2002 now. America's nursing a nasty dot-com crash hangover still. 9/11 just sucker punched the entire economy hard. Wall Street feels twitchy, but the Federal Reserve has solutions. Slash interest rates down to basically nothing at all. Boom, money's cheap now. Borrowing becomes ridiculously easy overnight. Suddenly, everyone's favorite pastime isn't baseball anymore. It's buying houses. Congratulations, you're approved for everything. $500,000, but you earn $40,000? Not a problem whatsoever. Adjustable rates, balloon payments. Ever heard of ninja loans before today? No income, no job, no assets required. No problem. Back in the early 2000s, this happened everywhere. Home ownership wasn't just four walls and a roof. It represented the American dream. Stability, status, suburban bliss. The message pumped through every advertisement and billboard screamed, "Why rent when you can own everything yourself?" Banks agreed enthusiastically. They threw money at people fast, like a game show where everybody wins prizes. Enter the subprime mortgage revolution. Translation is simple here. Loans for people with terrible credit and unstable income. Bad credit? No credit? Living in a van downtown? You qualify for a luxury condo immediately, sir. Should I worry about paying this back eventually? Not your problem. We'll sell the house higher. It became a housing gold rush, a frenzy. Everyone bought everything. Prices skyrocketed faster than expected. Your neighbor's house doubled in value within 6 months. Totally normal. McDonald's workers getting mortgages approved easily. Baristas with $5 in savings qualified too. Just a normal day in the 2000s era. The rules got launched straight out the window. Traditional lending standards felt too slow for everyone.
Risk assessments seemed too boring for profit margins. Down payments became optional. Pulse equals mortgage approved. People bought houses like they're buying ramen noodles. Lenders printed loans like monopoly money constantly. Mortgage brokers made commissions faster than saying bubble. Behind the buzz lived a blind faith deeply. Housing prices would always go up forever, right? They always had until now. What could go wrong? Spoiler alert, everything collapsed. We're just getting started. By 2005, buying houses changed completely. It wasn't about stability anymore at all now. It was flipping like pancakes for double profits. Real estate wasn't shelter. It became a lottery ticket. Teachers buying condos at night, third house, zero down. This wasn't investing. This became a national obsession immediately. Buy, flip, profit, repeat. The cycle never stopped. More people joined in, prices soared even higher, like putting out fires by throwing gasoline everywhere. But beneath the red-hot exterior, something rotted. Those subprime mortgages everyone gorged on were terrible. High risk, low documentation, barely verified debt everywhere. But Wall Street had a magic trick ready. They bundled junk together, slapped labels on it, sold it to investors as completely safe investments. Introducing mortgage-backed securities with 80% more lies. How do you make toxic loans look golden? Easy. Get ratings agencies calling them AAA. This bundle has bankrupt baristas and unemployed gym bros. Seems all right. Here's the dirty secret, though. Ratings agencies got paid by banks they rated, like hiring food critics, then paying only for stars. Behind closed doors, raters knew bundles were garbage. Wall Street wasn't done cooking yet. They blended further, took shaky mortgage bundles into something more complicated. Collateralized debt obligations, financial alchemy, transforming garbage completely. Actually, not everyone got fooled by this scheme. A handful of investors read the fine print carefully. They saw rot inside the boom clearly. Instead of buying in, they asked boldly, "What if we bet against it all?" Problem was, no product let you do that. They marched into Wall Street demanding insurance contracts. You want to bet against housing? That's adorable. Fine. You want insurance? We'll write it gladly.
You pay monthly. When nothing happens, we pocket premiums. Everyone wins, especially us. System won't collapse, right? Wall Street smelled easy money immediately. They created products, credit default swaps, insurance that paid if mortgages failed. The weird part, you didn't own the investment, like buying life insurance on your neighbor's grandma. The whole system became a Jenga tower made of lies. Every block a bad mortgage, every layer riskier. At the top, cheers to record bonuses again. Whistleblowers ignored, regulators sleeping, leaders too greedy. At first, just a whisper. Missed mortgages here, foreclosures there, empty condos in Vegas sitting. Then came the wave. The unthinkable became headlines. Home prices are falling. That's not supposed to happen. 2007, someone pulled the wrong block. Subprime loans started imploding. Mortgage-backed securities exploded completely. Banks realized they held radioactive garbage, not safe assets. AAA-rated bundles? Actually financial plutonium inside. We can't sell this junk. We're screwed. Panic spread like wildfire everywhere. Hedge funds bleeding, investment banks slashing billions in losses immediately. Then, boom, Lehman Brothers gone. 158 years. No bailout, no hero, $600 billion crater. The message was crystal clear now. If Lehman dies, anyone can. Banks stopped lending to each other. Credit markets froze solid, like someone yanked the power cord. Everything jammed. Families couldn't get mortgages. Businesses couldn't pay. Retirees watched pensions evaporate in real time, daily. 401ks, toast. Life savings, gone completely. By late 2008, full collapse mode. Millions unemployed. Foreclosures through the roof everywhere. Soup kitchens couldn't keep up with demand. Unemployment officers like disaster relief camps. This wasn't just Wall Street. This was Main Street in complete freefall. It didn't stop at U.S. borders either. Iceland's banks collapsed. Tokyo stocks plummeted. European leaders scrambled. From London to Tokyo, markets crashed. Banks buckled. The government had one impossible choice to make: let it burn or throw billions at arsonists. October 2008, they chose the latter. $700 billion for burning banks immediately. Entered TARP, Troubled Asset Relief Program, launched, basically giving Wall Street a $700 billion pillow. Banks too big to fail? Let them collapse. They'd take down the entire global economy completely. AIG got over $180 billion. GM and Chrysler, $80 billion. Unprecedented scale bailouts. Meanwhile, Ben Bernanke rewrote economics with money cannons. Interest rates sliced to near zero. Borrowing became free. Quantitative easing. Fed printed money from thin air, patching the Titanic with $100 bills everywhere. And guess what happened? It kinda worked. Markets calmed down. Banks unclenched. Stocks crawled back. Wall Street exhaled, but Main Street still choking badly. The aftermath was absolutely brutal for regular people. Unemployment hit 10%, 8 million jobs gone, 4 million homes foreclosed, 19 trillion wealth vanished. Families owed more than homes were worth now, and people were absolutely furious about Wall Street. Wall Street bonuses are back already? I got evicted. People who caused collapse got bailed out completely. People who lived through it got pink slips. Wall Street popped champagne. Main Street stood for soup. Then came the rage. 2011 Zuccotti Park. Thousands gathered. Tents, drums, cardboard signs everywhere. "We are the 99%, they screamed. It wasn't just bailouts. The system was rigged. Privatized profits, socialized losses. No justice delivered anywhere. No major Wall Street CEO went to jail. No handcuffs, just golden parachutes and quiet retirements. The system survived, but trust burned to ground. A generation learned when banks mess up, they're rescued. When you mess up, you get completely wrecked. Because 2008 taught us one thing: the next crisis won't look like the last. It looks harmless, profitable, inevitable, until it isn't.